The real reason $250,000 is the new turning point. You're scrolling through your bank account at 11 p.m. on a Tuesday, and you see a number that should make you feel accomplished. Maybe it's $87,000. Maybe it's $130,000. Maybe you've even crossed six figures in your savings and investments combined. You've done everything right. You got the degree, you landed the good job, you maxed out your 401k contributions, you cut back on the daily lattes everyone loves to blame for financial struggles. You've been responsible, disciplined even. And yet, there's this nagging feeling that you're still not quite there, not quite safe, not quite free. You're still checking your bank account before making purchases, still calculating whether you can afford that vacation, still wondering if one bad year could unravel everything you've built. And here's the thing that nobody really talks about. That feeling doesn't go away at $100,000. For a lot of people, it doesn't even go away at $200,000. My name is Nick, and I spend way too much time thinking about money, financial psychology, and why certain numbers seem to completely transform how people experience their financial lives, while other numbers that sound impressive on paper leave people feeling exactly the same as they did before. And what I've noticed, both in my own life and in talking to hundreds of people about their finances, is that there's something really specific that happens around $250,000 in liquid net worth that fundamentally changes the game. Not $100,000, not $500,000, specifically around that $250,000 mark. Now, I know what you're thinking. Great, another financial goal that feels impossibly far away. Or maybe I'll never get there, so why does this matter to me? But here's what's interesting. Understanding why $250,000 matters isn't just useful for people who already have it. It's actually most valuable for people who are nowhere near it yet. Because once you understand what that number actually represents, you can start making completely different decisions today. Decisions that don't just incrementally improve your financial situation, but that actually bend the entire trajectory of your financial life in a different direction. Because $250,000 isn't magic. It's not about the number itself. It's about what that number allows you to do, how it changes your relationship with risk, and why it represents the point where money stops being purely defensive and starts becoming genuinely offensive. And if that sounds abstract, don't worry. By the end of this, you're going to see exactly what I mean. And more importantly, you're going to understand how to think about your own financial journey completely differently, regardless of where you're starting from. The psychology of financial breathing room. Let's start with something that sounds almost too simple to be meaningful. $250,000 is roughly 5 years of living expenses for someone spending $50,000 a year. And before you say, well, I spend more than that, or I spend way less than that, just hang with me for a second, because the specific number isn't what matters here. What matters is that 5 years represents something psychologically profound that 2 years or 3 years just doesn't. Think about it. If you have 3 months of expenses saved, which is what most financial advice tells you to aim for initially, you have a small cushion. You can handle a minor emergency. Your car breaks down, your fridge dies, you need an emergency root canal. You're covered. That's defensive money. It's protection against the immediate, the urgent, the oh crap, I need this handled now situations. 6 months of expenses? That's better. That's job loss money. That's I can take my time finding the right next opportunity instead of desperately taking the first offer I get money. Still fundamentally defensive, but with a longer time horizon. 1 year of expenses saved? Now we're getting somewhere. That's I can make a deliberate career transition money. I can take a calculated risk money. But honestly, for most people, 1 year still feels tight. It still feels like the clock is ticking. You can hear it in the back of your mind counting down. But 5 years? 5 years is different. 5 years is long enough that you stop thinking in terms of countdown timers. It's long enough that you can make decisions based on what you actually want, not just what you can afford right now. And this is where the psychology gets really interesting, because at 5 years of expenses saved, something shifts in your brain. The constant low-level financial anxiety that most people carry around like background noise, it doesn't disappear completely, but it gets turned down to a whisper. I remember talking to a friend who had just crossed $250,000 in her investment accounts, and I asked her if anything felt different. She thought about it for a minute and then said something that stuck with me. "I don't check my bank account before I buy groceries anymore." That sounds small, right? Almost trivial. But think about what that actually represents. It represents a fundamental shift from scarcity thinking to abundance thinking. Not in some woo-woo manifestation sense, but in a very practical neurological sense. Her brain literally stopped treating every financial decision as a potential threat. The hidden compounding advantage. Here's where things start to get mathematical, but in a way that actually matters to your real life. And honestly, this is the piece that I think most people miss when they're thinking about wealth building, because we tend to think about saving and investing as linear. You save $10,000 this year, maybe $10,000 next year, and you're building wealth one brick at a time, which is true, but it's not the whole story. Let's say you have $50,000 invested and it grows at 8% annually, which is roughly the historical average of the stock market. In 1 year, you make $4,000 from your investments. That's nice. That's like a decent vacation or a small emergency fund boost, but it's not life-changing. Now let's say you have $250,000 invested at that same 8% return. In 1 year, you make $20,000 from your investments. $20,000. That's a part-time income. That's a used car. That's a legitimate contribution to your annual living expenses without you doing anything except continuing to exist and leave your money alone. And here's the thing that makes this exponentially more powerful. At $250,000, your investment returns start to potentially equal or exceed what you're actually contributing through active saving. If you're saving $15,000 or $20,000 a year, which is really good by most standards, and your investments are throwing off $20,000 annually, you've essentially doubled your wealth building capacity. You're no longer building wealth just through your labor. You're building wealth through your labor and through the accumulated capital you've already built. This is what people mean when they talk about money making money, but usually when you hear that phrase, it sounds either really distant and abstract or kind of gross and capitalistic. But the reality is much more mundane and mechanical. You're just reaching a point where the math starts working in your favor in a way it fundamentally couldn't before. Every dollar you had when you were at $25,000 saved was precious, but it wasn't working that hard for you. Every dollar you have at $250,000 is part of a machine that's generating meaningful returns. The career risk equation. This is probably the most underrated aspect of having $250,000 in liquid net worth, and it's something I didn't fully appreciate until I watched several friends navigate this in real time. When you have 5 years of living expenses saved, you can take career risks that are functionally impossible when you're living paycheck to paycheck, or even when you have 6 months or a year saved. Let me give you a concrete example. I know someone, let's call her Maria, who was working a pretty comfortable corporate job making about $95,000 a year. Good benefits, stable, fine. Not amazing, but fine. She had an opportunity to join a startup in a role that was genuinely exciting to her, but the base salary was only $70,000 with equity that might be worth something eventually or might be worth nothing. Classic startup gamble. With 3 months of expenses saved, there's basically no universe in which that makes sense. You're taking a $25,000 pay cut with no safety net. That's not a calculated risk, that's just, well, risky. With a year of expenses saved, it's maybe possible, but it still feels terrifying because you're betting your entire safety net on this working out. But Maria had about $280,000 saved and invested, and with that cushion, the calculation became completely different. She could take the pay cut, knowing that even if the startup completely failed after 2 years, she'd be fine. She wouldn't have to liquidate her investments, she wouldn't have to move back in with her parents, she wouldn't have to take the first job offer that came along out of desperation. She had time and space to make it work, or to pivot intelligently if it didn't. Spoiler, the startup did pretty well. Not life-changing, buy a yacht well, but the equity she accumulated over 3 years was worth about $150,000 when the company got acquired. And more importantly, the experience she gained put her in a completely different tier of career opportunities. She's now making $160,000 in base salary at her next role, plus significant equity, and she's doing work she actually finds meaningful. But here's what really matters. None of that happens without the financial cushion to take the initial risk. And this pattern repeats over and over. The people who can afford to take strategic career risks tend to end up in dramatically better career trajectories than people who are forced to always take the safe path. It's one of those things that sounds like it should be fair, but isn't. The people who already have money can afford to take the risks that generate more money, while the people who need money the most have to play it safe. I'm not saying this to be depressing, by the way. I'm saying it because once you understand this dynamic, you can start planning for it. You can say, okay, my goal isn't just to save money for emergencies. My goal is to build a war chest that gives me career flexibility. That's a different mental